Imagine a country so short of dollars that it has to pledge its gold just to pay its bills. That was India in 1991. Just weeks later, the country announced economic reforms that changed India forever. So, what forced India to liberalize? For decades after independence, India followed a state led economic model. Businesses needed government license to expand, imports were tightly controlled, foreign companies faced strict restrictions, and many key industries were dominated by the public sector. The goal was self reliance, but over time, the system became known as the license Raj. Businesses competed for approvals instead of customers. Competition remained weak, and the economy grew at an average of just 3.5% between the 1950s and the early 1980s. The 1980s looked more promising with faster economic growth, but much of that growth was financed through borrowing. By 1990-91, India's fiscal deficit had surged. External debt had jumped to around $70 billion, and a large share of export earnings was going towards repaying those loans. India was growing, but on borrowed money. Then everything went wrong at once. Iraq's invasion of Kuwait in 1990 pushed up oil prices and India's import bill. At the same time, the Soviet Union, one of India's biggest trading partners, began collapsing, disrupting trade and reducing access to foreign exchange. International lenders also became reluctant to extend fresh credit. By June 1991, India's usable foreign exchange reserves had fallen to about $1.2 billion, barely enough to pay for 2 weeks of imports. To avoid default, India pledged 67 tons of gold overseas and sought emergency assistance from the International Monetary Fund. The crisis exposed a deeper problem. It wasn't just that India had run out of dollars. Its economic model had run out of steam. In July 1991, Prime Minister P.V. Narasimha Rao and Finance Minister Manmohan Singh launched sweeping economic reforms. Industrial licensing was abolished for most sectors. The rupee was devalued, import barriers were reduced, foreign investment was opened up, and the role of the public sector was gradually scaled back. Those reforms transformed India from a tightly controlled economy into one that relied far more on markets, competition, and global integration. 35 years later, economists still debate different aspects of liberalization. But one thing is difficult to dispute. Without the crisis of 1991 and the reforms that followed, India's economy would almost certainly look very different today. Follow Business Standard for more such stories.